Welcome to Module 4, Lesson 2 of Fundamentals of Accounting. In this lesson, we'll explore a vital topic in accrual accounting: accrued and deferred accounts, what they mean, when to use them, and how they impact the financial statements of a business. These accounts play a critical role in applying the accrual basis of accounting, ensuring revenues and expenses are recorded in the correct period, even when cash hasn't yet changed hands. Let's start with a simple question. Why does this matter? In real business operations, transactions don't always follow the timing of cash flow. For example, a business might complete a project today and get paid next month, or pay for rent in advance for the next quarter. If we waited until the cash moved, the financial records wouldn't show the true performance of the business in each period. That's where accrued and deferred accounts come in. They help you record what actually happened, regardless of whether money has been received or paid. Accrued accounts. Let's begin with accrued accounts. The word accrued means that something has already happened, revenue has been earned, or an expense has been incurred, but the business hasn't yet received or paid the cash. The financial impact has occurred, but the money hasn't moved yet. There are two main types. 1. Accrued income, also called accrued revenue. Account type, asset. When it's used, you've earned income but haven't received the money or even issued the invoice yet. Example, a freelance bookkeeper completes a 10,000 job in March but will invoice and receive payment in April. Journal entry, Dr. Accrued income, asset, 10,000, service revenue, 10,000. This ensures March reflects the revenue that was truly earned, even though cash hasn't been received. 2. Accrued expenses, also called accrued liabilities. Account type, liability. When it's used, an expense has been incurred but the bill hasn't been received or paid. Example, a business knows it used 5,000 worth of electricity in March but the bill hasn't arrived. Journal entry, Dr. Utilities expense 5,000 SOR. Accrued expenses, liability, 5,000. This makes sure the expense appears in March when the service was actually used. Deferred accounts. Now let's talk about deferred accounts. Deferred means delayed. Cash has already changed hands, but the income or expense hasn't occurred yet. Here, you're holding off on recognizing the revenue or expense until it truly happens. 1. Prepaid expenses, also called deferred expenses. Account type, asset. When it's used, the business paid for something in advance, but will receive the benefit later. Example, you pay $12,000 for a 6-month insurance policy in January. Initial entry, Dr. Prepaid insurance, asset 12,000 core. Cash, 12,000, adjusting entry monthly. Dr. insurance expense, 2,000 core. Prepaid insurance, 2,000. Each month, the prepaid amount becomes an expense, matching the cost in the cost to the period it benefits. 2. Unearned revenue, also called referred revenue. Account type, liability. When it's used, you've received payment in advance, but haven't delivered the service or product yet. Example, in March, a client pays Delay 15,000 for a workshop scheduled in April. Initial entry, Dr. Cash 15,000. Unearned revenue, liability, 15,000. Adjusting entry, when service is delivered, Dr. Unearned revenue 15,000, service revenue 15,000. This ensures income is recorded only when it's truly earned. Now let's take a moment to understand the principles and standards that support the use of accrued and deferred accounts. These aren't just technical rules, they're the foundation that gives accounting its consistency and credibility. Let's go through 4 key principles, one by one. First, we have the matching principle. This principle says expenses should be recorded in the same period as the revenues they help to generate. For example, if you earn income from a service in March and it required advertising, even if you pay the ad agency in April, you still record the expense in March because that's when the income happened. Second, the revenue recognition principle. It tells us, record revenue when it is earned, not when the cash is received. So if you completed a service in April but the client pays you in May, you still record the revenue in April. The focus is on when you delivered the service, not when you got paid. Third, we have the accrual concept, which is part of GAAP and IFRS, two major accounting frameworks used globally. This concept tells us, recognize transactions when they occur, not when the money changes hands. This is what allows businesses to record income and expenses even when no cash has moved yet. And finally, the consistency principle. This principle says, once you choose an accounting method, you must apply it consistently each year. So if you use the accrual method this year, you can't suddenly switch to cash basis next year just to make the numbers look better. This helps users of financial statements compare performance over time with confidence. In summary, the matching principle aligns expenses with the income they support. Revenue recognition focuses on when you've actually earned your income. The accrual concept ensures transactions are recorded when they happen, not just when cash moves. And the consistency principle makes sure you stick to the same rules year after year. These principles make accrual accounting more reliable and more reflective of real business activity. Let's now do a quick side-by-side comparison between accrued and deferred accounts to help you clearly understand how they differ. First, the timing. When do you recognize the transaction? For accrued accounts, you recognize the transaction before cash is paid or received. For deferred accounts, you recognize it after the cash is paid or received. Think of accrued as earned or used but not yet paid, while deferred means paid or received in advance. Second, examples. What are some typical examples of each? Under accrued, we have accrued income and accrued expenses. Under deferred, we deal with prepaid expenses and unearned revenue. So accrued income is like work already done but not yet paid for. Unearned revenue, on the other hand, is money you've received but haven't done the work for yet. Third, how do they appear in the financial statements? Accrued income appears as an asset because it's money the business will receive. Accrued expenses appear as a liability since it's something the business owes. For deferred accounts, prepaid expenses are an asset because the benefit is still to come. Unearned revenue is a liability because you owe a service or product in the future. Finally, what's the purpose of each? Accrued accounts help reflect what has already been earned or incurred, even if no cash has moved yet. Deferred accounts help delay recognition until the service has been delivered or the product has been used. Memory tip. Here's a helpful way to remember. Accrued equals recorded now, paid or received later. Deferred equals paid or received now, recognized later. Common mistakes to avoid. Don't record prepaid expenses all at once. Spread them over time. Don't recognize unearned revenue too early. Wait until the service is done. Always check. Has the event occurred? Has cash moved? If they don't match, adjust. Summary. What gets adjusted? Here's a quick recap of what typically needs adjusting under the accrual basis. Assets, like supplies, prepaid rent, and accrued income. Liabilities, like accrued expenses and unearned revenue. Revenues, earned but not yet recorded. Expenses, incurred but not yet paid or spread over time, like depreciation. These adjustments ensure your financial statements are not just accurate, but honest, timely, and principled. You've just mastered a critical element of accrual accounting. These adjustments might seem small, but they create big clarity in financial reporting. End of Module 4, Lesson 2.